With so much to cover, of course, across the economy, the Fed's next move, and the stock market here at the New York Stock Exchange, I do want to bring in Danielle DiMartino Booth. She's the CEO and Chief Strategist at QI Research. Danielle, it's great to have you in studio, of course, on a very busy morning.
Indeed.
What do you make of this action?
Boy, every morning is busy, isn't it? You almost can't sleep in this environment. I think my Bloomberg chat room was completely open the entire day Sunday. I haven't had one of those in a while. There is a lot to look at. I think that the minutes today may be a little bit disappointing from the Fed in that they're going to feel very dated in that so much has happened since the Fed last met. But as you say, we've got the CPI coming up, the PPI coming up, and some really critical reports, first quarter GDP, and another payrolls report coming out on May 2nd. That's 5 days before the Fed meets. So there's a lot on the Fed's plate. When you start to see intraday volatility, major swings in the markets, whether it's the bond market or volatility or the stock market, as we're seeing, you even start to hear rumblings about whether or not the Fed may have to intervene, coming with a rate move, with a rate cut, even before they meet next.
Interesting. So you mentioned, and we covered here, May 7th, that is the next Fed decision.
Right.
But it is a bit of a tricky environment for them because the latest we had heard from the Fed chair is that he does foresee inflation rising and growth coming down. What more can you share there?
Well, I think when you hear, when you read headlines and you see that Delta's pulling its guidance for the year, that it expects for especially, kind of its main cabin to be pressured, those are the kinds of things that reflect what a lot of Wall Street houses right now. In fact, Jamie Dimon just said recession is probably the base case here. Goldman Sachs made a similar comment just yesterday. That tells me that the Fed's going to have to be paying also attention to its employment mandate and how quickly companies react to this kind of shock to the economy of tariffs, and whether or not we're going to see layoffs supersede the Fed's concerns about inflation. That's the big debate right now.
Danielle, you had joined us a few weeks ago remotely. We're happy to have you in studio today. And even the word recession was a question at that time.
Right.
What is the growth forecast that you see right now?
Well, we saw something very unusual come out on Monday morning. It's kind of a B team type of economic indicator, but we saw consumer credit hit. Very unusual to see credit card spending and student loans and auto loans contract in the same month. Now, this occurred in February. So what we're seeing right now, the Dallas Fed came out with a banking survey. Bankers were saying we're not seeing loan demand. We're tightening credit standards. That was taken, I think that survey ended on April the 2nd, before Liberation Day. So what we're seeing is, prior to even this latest round of volatility and disruption, that the economy was definitely slowing.
And we already see the stock market down about 19% from its high with the losses at the open. We are looking to open in a bear market down 20%. Do you think equities could fall further from here based on the scenario?
Well, if recession is going to become the base case, and typically when your sell side big banks are saying that it's the base case, it's typically looking through the rearview mirror. We typically already are historically in recession. And if that's the case, and I would concur with what they're saying, recession, even though we're talking about a true correction down 20% in the S&P 500, recession's not priced into the stock market.
And so what does that mean?
Well, that means that there's going to be, I think, further downside, possibly, unless we get some kind of a major reversal in policy. I think that there's going to be continued downside. I'm watching credit spreads the most closely because even though we've had gyrations in the stock market for some time, we've had uncertainty in the data. We've been in an industrial recession for a long time. Throughout all of what we've seen in the last 12 to 18 months, we've seen the credit markets very well behaved. And that was something else that JP Morgan's Jamie Dimon said this morning, and that is, I expect to see more defaults. I expect to see credit begin to unravel. And when you do see that, credit does spill into the equity market.
I'm curious here in terms of where we go on tariffs. We had seen, obviously, levies of more than 100% enacted on Chinese imports just after midnight by the U.S. China retaliated this morning. What kind of scenario does this set up potentially?
So, as sensitive as we are to headlines now you've got Japan and now Vietnam coming to the table. I think the markets are going to begin to try and tease out which countries are going to be affected, how that's going to play into the U.S. economy. And for the moment at least, if we start to see individual countries coming to the negotiating table, that could provide a little bit of near-term positivity for markets. That being said, when Treasury Secretary Scott Bessent was asked this morning, would you even consider delisting Chinese stocks? He said everything's on the table. So as it pertains specifically to China, it seems like that uncertainty element is going to continue to stay very elevated, and that we're going to continue to watch, as we're watching a trade war play out. That's the environment we're in when we wake up and say, okay, China's answered our latest lobby. What's going to happen next in the United States? It's like watching a tennis game.
Danielle DiMartino Booth, she's the CEO and Chief Strategist at QI Research. Danielle, thank you so much for joining in studio.
Thank you for having me.